Welcome back to The Explainer. Today, we're going to unpack the hidden trade-offs and the fascinating financial math behind some of our biggest life and wealth decisions. We'll be pulling all our data and insights straight from the May 2026 edition of ET Wealth. So if you've ever wondered about the real, calculated costs of your everyday choices, you are absolutely in the right place. Here is our roadmap for today. We're covering 4 key areas: metro versus small town, avoiding the Benami trap, buying digital gold today, and paying for mutual fund advice. Let's dive right in. First up, Section 1, metro versus small town, and the actual relocation math. So many of us are making the physical and emotional transition right now. We're trading the towering skyscrapers and the chaos of a metro for the quieter, much more balanced appeal of a Tier 2 or Tier 3 city. But before you start packing up those cardboard boxes and booking that moving truck, we really need to look at the hard numbers. Just looking at this, the real estate savings in Tier 2 cities are frankly staggering. I mean, a 3 BHK in Mumbai might run you nearly 1.92 lakh rupees every single month. But drop down to a place like Jaipur or Indore, and you're looking at around 34 to 35,000 rupees. Your total family cost of living drops dramatically too. It seems like an absolute obvious win for your wallet, right? But wait, what is the hidden cost here? Well, here is the reality check. Take Vaibhav Jain's story. He moved from Bangalore to Indore assuming life would just automatically be cheaper. But guess what? He found his expenses barely dropped, maybe 10 to 20%. Meanwhile, his income plummeted by 40 to 50% as he had to try and rebuild his career in a smaller market. That is a massive hit to your actual savings rate. But, on the flip side, the math isn't always just about the money. Look at Sheil Jaitley. She took a really significant 60 to 70% income hit moving to Manipal, largely to help with her son's health issues triggered by city pollution. For her, that quality of life index, the cleaner air, the safety, and just being close to family, that completely overrides the loss of her metro earning power. It's a great example of how deeply personal this math truly is. All right, moving on to Section 2, avoiding the Benami trap, or what we can call the legal math. So let's say you made that move to a Tier 2 city and actually managed to save up some real money. Naturally, you want to invest it. Now, it is incredibly common in India to hold real estate, mutual funds, or bank deposits in a family member's name. But listen closely here, because the law has drawn a very strict line on this practice, and crossing it could literally cost you everything. The absolute crucial point here is understanding this exact definition. The Prohibition of Benami Property Transactions Act is actively targeting these hidden ownership structures. Basically, the Benamidar is the name on the paper, but they are not the person who actually paid for or controls the asset. You definitely want to pay close attention to your own portfolios here. The law absolutely does allow genuine family arrangements. Buying property in the name of your spouse or child, totally allowed, and you don't even need to hold it jointly. If it's a sibling or parent, it's also allowed, but joint holding is required there. But, and this is a massive but, hiding assets under a friend or distant relative's name is not just illegal, it's heavily penalized. And get this, even if you sell a Benami asset and buy something completely new, that new asset is still legally considered Benami. And the consequences? They're definitely not just a slap on the wrist. Just reporting impartially on the facts here. In the recent Manjula versus Srinivas Supreme Court ruling, the court made it crystal clear they are enforcing the strict 2016 framework retrospectively. That means if you get caught, you don't just lose your legal claim to the property. The state will simply confiscate the asset entirely, leaving both parties empty-handed. Plus, it can even carry up to 7 years of imprisonment. Serious stuff. Okay, let's pivot to Section 3, buying digital gold today, and the investment math behind it. We all know gold has always been this highly emotional, very physical purchase in India. But things shifted as of May 2026, when the NSE launched trading for electronic gold receipts, or EGRs. Think of these as digital certificates that sit right there in your DMAT account, but they're fully backed by actual, physical gold locked safely away in SEBI-regulated vaults. EGRs fit perfectly into the investment puzzle. See, unlike buying a physical coin from a jeweler, purchasing an EGR on the exchange lets you completely skip that 3% upfront GST. And unlike a gold ETF, which is really just pure financial exposure, with an EGR you actually retain the right to convert that digital receipt back into real physical gold down the line if you ever want to. But, of course, the math always involves a trade-off, right? It's awesome that there's no capital gains tax triggered when you convert between the receipt and the physical gold. But while you avoid the GST at the initial purchase, you have to factor in the hidden costs, ongoing vault storage fees, demat charges, and withdrawal fees when you eventually take delivery. Plus, because the market is still quite new, lower trading volumes mean you might face wider bid-ask spreads. Finally, let's wrap up with Section 4, paying for mutual fund advice, and looking at the portfolio math. Over 2,500. That is the sheer number of mutual fund schemes available in India right now. It is a massive problem of plenty. This kind of clutter just completely overwhelms investors. And you know what it leads to? Emotional, poorly timed trades, like chasing last year's hot performer or panic selling the second there's a dip in the market. To try and solve this, wealth tech platforms are pitching something called a mutual fund PMS, portfolio management services specifically for mutual funds. But you've got to choose your fee structure super carefully. A profit-sharing model sounds great, doesn't it? Like they only win when you win, taking about 20% on incremental gains. However, independent analysis shows that in strong bull markets, this profit-sharing model can actually cost you 2 to 3 times more than simply paying a flat fee of 0.6% to 1% annually. You really have to beware of the hidden drag on your returns, the dreaded double dip. You're paying that PMS management fee on top of the underlying mutual funds expense ratio. If they use actively managed funds, your total fee drag could hit 4% every single year. Oh, and every time the PMS manager shifts your funds around to optimize the portfolio, boom, that creates an immediate taxable event in your demat account. Honestly, sometimes a simple, flat-fee registered investment advisor might just be the mathematically smarter choice. So as we've seen today, looking through the ET Wealth data, absolutely every choice carries a hidden cost and a hidden benefit. Whether we're talking about the income drop of a simpler life, the severe legal risks of hiding assets, the storage fees on digital gold, or the tax drag of portfolio management. So I want to leave you to review your own life choices and your own portfolio and ask yourself this final question. Are your financial moves truly calculated? Keep learning, keep calculating, and we'll catch you in the next explainer.